Welcome back to another episode of the Wealth Building Strategies Podcast. I'm your host, Jeremy Constantino, and today I am joined by an excellent guest, Jeff Greenberg. Welcome, Jeff, to the show.
Well, thank you for having me. I'm excited to get started.
Excellent. So for those of you that don't know Jeff, Jeff is the Chief Executive Officer of Synergetic Investment Group, also known as SIG. And Jeff and your company for over 12 years been syndicating multifamily apartments and housing properties. So congratulations on your success and your career in syndications.
Well, thank you.
And so today we're going to talk about something that nobody's talked about on our show. And we're talking about a customizable and a diversified private equity fund. So I'm interested to hear what Jeff has to say and what he's doing with SIG. But I guess first of all, let's get to know you, Jeff. Where you come from and what's your background? How'd you get into real estate?
Well, I came from, I've been in Southern California all my life. So I'm actually second generation Angelino in Los Angeles here, which is pretty unusual. I don't find too many people that are second generation. My mom actually was born in Los Angeles.
Wow.
But as far as my voyage, just on a hike with a friend when I was just starting of a divorce, we were having a conversation about investing in real estate. And I had no clue what that meant other than maybe buying a single family home and renting it out. I thought that was investing in real estate. And so that was kind of the beginning of my voyage, and then went on from there.
So did you get into single family rentals first, or did you just jump right on into multifamily?
I tried to get into REOs. It's hard getting into rentals in the Southern California, Los Angeles area, because typically the numbers don't work. Typically your rents aren't going to cover your expenses. And so that really wasn't an area I was going to focus on. So we did start looking at bank-owned properties. This was about in 2005, 2006, 2007. And so the banks were starting to see some foreclosures. And so that was what we were looking at, is getting involved with that. But that was also difficult, especially around 2006, 2007, where the banks didn't know what to do. They started getting so many foreclosures that they had no idea what to do about them, and values were dropping so fast. Right. It was pretty difficult to get involved and actually come out with a profit.
So how did the multifamily investing come about?
Well, I met somebody at one of the conferences that was doing it in commercial real estate, realizing that I could get into commercial real estate with a limited amount of money, which is what I had going through the divorce, realizing how much money I didn't have or how much I was going to lose on my house. I had to figure out what I could do with the amount of money I had. And when I heard a gentleman talk about using other people's money to invest in real estate, I said, hey, that's what I got to do, and spent most of my money educating myself and getting an education and getting into deals, but typically getting my money out after the deal was closed, which worked out well for me that way.
Yeah. So so you have over 12 years of multifamily investing. So there's multifamily and syndications, it seems to me. So I've been investing since 2005, and it really seems the popularity or the awareness of multifamily syndications has significantly grown in the last decade. So sounds like you were there before this recent uptick.
Yeah, when I first started, there was a couple of gurus out there teaching. And, anytime you have them out there, with having events with thousands of people, it starts to spread more and more. Right. But there was only a couple of people that I knew that are actually doing it.
Right.
Now, a lot of their proteges are out there doing it as well.
Right.
So a lot of those people that went through a lot of those programs are now doing more events, more seminars. And so it's much more common now,
Right.
especially in some of the larger metros like Dallas, where there's a lot going on down there.
Yep. All right. So let's talk about SIG and what you guys have going on there. And so I guess talk to us about your customizable fund. What does that mean?
Well, first of all, on my background, as you said, I've been syndicating for the last 12 years. I've always been the main GP on all of my deals. I mean, I did some LP investment as a limited partner prior to starting doing my own deals. But I found that even though I had other teammates, I was wearing multiple hats and
Right.
doing a lot of it, and realized as time went on that there were certain things that I was good at, certain things that I enjoyed doing, and there were certain others that I didn't enjoy doing, and therefore I wasn't good at them. And one of the things that I found is I enjoyed working with investors. I enjoyed educating investors. I enjoyed helping them bring them into the business. And so over the past year or so, I've been mainly raising money and letting somebody else do a lot of that other heavy lifting. And because of that, I've been thinking for a long time about a fund. Now, there's different kinds of funds. Initially, while I was still syndicating, I thought, okay, I'm going to do a fund, I'll raise money, and that will be for my deals only. So I would raise money ahead of time for my deals, make it much easier to get into deals because I would know that I had that money. Now, the problem is when you do something like that, you have to have enough deal flow to be able to continually move the money and be able to invest people's money. Well, I wasn't comfortable with that, with the amount of deal flow that I had. And also, people are coming into a blind fund. Essentially, they have to trust you, but they don't really get to see any new deals coming in because they're in those deals if they like them or not.
Right.
And there's typically a lot of resistance to that. And so what I was rather excited when, first of all, when I decided I wanted to do a fund and invest in other people's deals, that was something I felt, okay, I could increase the deal flow because now I can get into other people's deals, other quality deal sponsors, get into their deals, and of course, increase the deal flow. So that should make it, much easier to raise money. But I discovered that I could also make the fund customizable, that I could set up a fund where people did not come in blind, that they could see every deal and decide at that point if they want to be in that deal. They would not have to be in every deal. They could be in whatever deal they wanted. Now, this gave me great flexibility because now not only could I invest with all different deal sponsors, but I could invest in all different asset types. And initially, if you're doing a blind fund and somebody knows that you're going to look at all different asset types, some people might not like certain asset types and may not want to be involved in it. Well, by having a customizable fund, I could go and put all kinds of opportunities into the fund, and the investor gets a choice if they want to be in that opportunity or not. So I can not only do all different asset types, but I could also do some that are heavy on cash flow, some that may be heavier on capital appreciation, and my investors get to self-diversify. They could pick and choose which ones they want to be in. If they want to be heavier on cash flow, or if they want to be heavier on capital appreciation, they get that choice. And so when I discovered that, I said, oh, this is exciting. This is great. This is what I wanted to do. And so right now I have two different funds, and we're bringing different opportunities into the two different funds. And the reason I have two different ones is one is a 506B, which non-accredited investors can invest in. I can't advertise. I can't talk a lot about the opportunities. And I have another one that's a 506C, which I could go and talk a lot about because it's only accredited investors allowed being in that. So I'm excited about both of those funds.
I really like what you're describing here, and it's not common in the world, you know, in these groups of these gurus that you're talking about in these investor meetups. So from a limited partner perspective, I have to, it's a challenge from the limited partner because I can only see a couple deals a year from that connection that I have made with a general partner. So if I go to these investor meetups and I start meeting some of these general partners, okay, I may have 2 or 3 or 4, but what they're giving to me is just their niche. They're giving me only their self-storage asset, or they're giving me only their multifamily deals. But as a limited partner, that's exactly my goal. I need to diversify my portfolio across different assets. So the challenge is now I have to meet multiple different GPs and really spread myself thin. And it's just a headache because, and I actually did, I'm sorry, I'm talking so much. I'm feeling the pain of the limited partners because this last December, I completely cashed out my 401k and moved it over to a solo 401k, and I diversified it exactly like this amongst many different general partners and different sponsors projects. But what entails for me is now I have to go to multiple different web pages, multiple different investor portals. I'm communicating with different people on my K1s and all kinds of stuff. And it's just a big headache because I'm diversified, but it's more work for me. Sorry,
well,
I'm probably preaching to the choir
no,
here.
that's perfect, because I've had many people like you come to me and say, first of all, they would ask me, how do I find good deals? And then I go and I tell them, well, first of all, that's the wrong question. The question should be, how do I find good deal sponsors?
Right.
And then, as you said, have the opportunity to invest in those deals. And so that's where I put myself in the middle there, that I'm spending my time seeking out good deal sponsors, getting to know good deal sponsors. And then after I've done my due diligence on them, I'm happy with them, then I'm waiting for their deals. So when their deals come in, I've already done my vetting on them, and now I could go and offer those. And sometimes I have deal sponsors that come to me and say, hey, I got this great deal. And I say, well, that's not how it works. I need to know you first. And more than likely, I'm not going to be looking at their first deal because I need the time to get to know them and to understand them and their business. So I'm probably not going to be into their first deal. And it may take a little while. It typically takes me a while to be comfortable with the deal sponsor. And so that's the spot I put myself in. And investors could just look at the deals that I bring in, and they could decide whether or not they like them. Once in the fund, they're only going to have to worry about one K1. So no matter how many opportunities within the fund they're in, they get one K1 at the end of the year.
Yeah, that's fantastic. Your company is providing a valuable niche that I'm not seeing in our market right now. So thank you for doing that. I want to go back to what you said earlier about as real estate companies, investment companies, we start growing, we realize that we need to focus really on our own niche and what we're really good at doing. And that's really interesting that you said, yes, I'm interested and I'm better at the investor relations side than, maybe the searching for properties and the managing the properties and being the operator.
Yeah, well, I mean, I know a lot of people that love that part. That's their challenge. To find properties, to build those relationships and get it. That never excited me. And so my job is to find those guys that get excited about that. and are also the good quality operators. On the last property that I did as the main operator, I brought on an asset manager, and watching her work and working alongside of her as the asset manager. And for those of you that aren't aware, the asset manager basically represents the ownership, and works directly with the management company and make sure that they're running the business plan as they should and keeps tabs on that. And there's constant details that they keep track of. Well, I watched her work and I enjoyed so much coming to the meetings, knowing that she was running the meetings, she was leading it. I was just listening. I didn't have any work in preparation to come in the meeting. I didn't have any work to do after the meeting. And she was working her tail off, and made an extremely successful deal for us. Realized, man, this is all I want to do, is I want to work with quality people like her.
Right.
And so now currently I brought funds into 2 of her deals that she's the main GP. And so I get to work with her again for those deals. And there's other people that are similar to that I've met, and they're high quality operators. And I get to do that as well, that I get to come in, bring my investors in, work with investors, and don't have to worry about the operation ends of it.
Yep. When talking about what I do with my wife or some of my close friends that are getting to know me, what do I do? And, I'm in real estate investing. Okay, what do I do? And when I explain what I do, it really is, I am really in 2 separate businesses. I'm in a business of operating and managing real estate and finding real estate deals and selling deals. And then what is completely different business and a completely different business model is providing good returns and safe investments for investors. It's two different worlds.
Mm-hmm. And I've pulled myself out as far as, the operations end of it.
Yep.
And, my quality of life is improved immensely. Except I still have 1 property that I still have operation responsibilities on. I have some asset managers that are working it, but as soon as I sell that property, then I'll be freed up from that completely. And, that will improve my quality of life. And I get to enjoy working with investors and enjoy my grandkids.
Yeah. So right now I am in a fund of fund model right now,
Mhm.
where raising capital and bringing investors to invest in another fund. It's just I'm feeling the excitement of what you're talking about, of a customizable fund that has multiple different projects in it and not just one. So I guess how many total projects or how many total real estate assets are in one of your funds at a given time?
It depends. I mean, it depends. The funds are new. As I said, I've just been doing this within the last little over a year, and I currently have 3 opportunities in the 506C, and then 2 in the 506B,
Okay.
which is a little bit harder finding 506B opportunities with good quality operators.
Right.
But we're moving slowly, but that's kind of how I do it, that I need to make sure that I get quality deal sponsors, and I don't quickly jump into opportunities. We do it, slow and steady as we go.
What asset classes are you focused?
Well, let's see, I've got a new development that just actually it's up to 95%. We got into that one. It was about 30% occupied, just a new development in Dallas. We've got couple of multifamilies, a couple in Houston, San Antonio, and also in Kansas City. We also got a Bitcoin mining fund, and we've got a portfolio of short-term rentals.
Wow.
And
Okay.
so currently looking at some assisted living, doing a little looking out for that one. I do like RV parks. So I'm looking at find a good sponsor for that, as well as self-storage. mobile home parks. Those are a few of them that I'm looking at.
I'm glad you're mentioning the geographic locations as well, because investing in real estate is good. You need to be diversified, but not only in asset class, but also in different markets as well. Because the United States when people say, "Oh, how's the real estate market is doing in the United States?" You're like, "Well, every market's different." So, that's my passion and my goal also to give investors a diversified options. So I like how you're spread across different markets.
Yeah, well, when people say that, or when you see it on the newspapers, and I can remember on the news back in, what was it, 2008 or whatever, when they say that the market is down, the real estate market is down by 5%, or and I'm sitting there is no such thing as the real estate market.
Right.
As you said, I mean, because I knew areas that were still going up. There's areas out here in Southern California that didn't drop. There were other areas that near me that dropped 50%.
Right.
So it just depends. There is no the market. It's multiple markets, and that could be changing. That could change from block to block, neighborhood to neighborhood. And that's why finding sponsors that know their niche
Right.
very well is the key. Very important.
And I'm surprised at however many years I've been in real estate, the media and the fear mongers out there really have a grip on the average person, and they really believe when the media says, "Oh, the real estate market is down," then they say, "No, I'm not going to invest." But then that's our primary job, is really educating the investors and say, "Look, we've done our due diligence. We have sponsors that know these markets. Here's the market data. Here's the job growth. Here's the population growth. Here's the actual data for this market and for this project." And then that's our job, to educate them.
Right. And there's so many different areas of real estate, especially commercial real estate. So many different aspects of it. Some are much more resilient to fluctuations in the economy. Others are less so. And so knowing which ones to look at. And also, one of the first things that I talk to deal sponsors about is, how do you reduce the risk to investors? Right. What are you doing in this particular deal that you're showing me to protect the investors?
Right.
Protection of the investors' money is the most important thing. And a lot of times investors, when they're looking at a deal, the first thing they're doing is looking at the IRR, cash on cash return. How much money am I going to make? And that's a dangerous way of looking at things. You want to know, what are they doing to make sure this deal is safe or safer, and what the sponsor's doing to reduce the risk. And then afterwards, once we're convinced and we like those answers, then we could talk about how much money you're going to return.
Right.
First, it's the safety first, and protecting people's investments.
Absolutely. Absolutely. All right. So any last thoughts here on your future for your investment group and your company? Where do you see you guys headed?
Well, like I said, we're looking for different asset types. I'm definitely talking to several deal sponsors in some different areas and getting to know them. And once I determine, that I like them and I like their opportunities, we'll bring those in. If people are looking to learn more about different ways of diversifying into different commercial real estate asset types, certainly they're welcome to contact me. I always enjoy talking to people and enlightening them on, the different aspects. It's an exciting business, and I always want to hear from people.
Excellent. Yeah, I'm co-owner in a handful of different real estate brokerages, and we have over 300 agents. So a lot of my listeners and viewers are real estate agents, and surprisingly, I just had an appointment with a potential investor that's a top producing agent in North Carolina, or two of them. They're two top producing agents, and they're doing really well in their in their sales, but their experience in passive real estate investing is negligible. And as I was explaining some of our one of our opportunities to them, they don't even know the basic numbers, like you're saying, IRR, and so all that being said, some of the listeners here are maybe new to investing passively, but very seasoned in real estate. So I guess final words for them. Do you have any advice to real estate agents that are looking to start investing passively?
Well, find somebody that is doing it and talk to them and learn. The main thing is learn the underwriting, which I agree with you. I found amazing dealing with commercial real estate brokers and agents that they really didn't understand the returns. Right. We would get something from them and they'd give us, they'd tell us, okay, this is the cash on cash return that you're going to get. And then I would look at it a lot of times and they would only be including the initial earnest money, or the down payment that you're paying on it, and not even the additional expenses. Not the closing costs, the loan costs, all these other things. So of course the cash on cash looks great because they would show you that you're not putting in as much money as you really have to put in to get into the deals. And I've also been surprised over the years how few are investors.
Right.
I mean, I've had brokers that are looking at deals and showing me deals, and I say, hey, you want to invest with us? You could come in as an investor if you want, because he's talking about what a fantastic deal this is. This is great. Well, do you want to come in as an investor? Well, I haven't really done that. I haven't paid off my student debt, student loan debts, and whatever excuses they had.
Yep.
They didn't understand the mentality of an investor.
Yep.
They were more of a salesperson,
right,
that understood, the sales process, but didn't understand the investing. And so I'm surprised that few.
Yeah, it is. It's very small, and they're not going to be. They're going to need to go into retirement just like everybody else, and they're going to need to have cash flow coming in. So,
that's right. When they quit working, the money stops.
Exactly.
If they don't have the residual, if I can get my mouth to work, residual income, continuing to come in. Right. And so typically, as I'm sure that you do, I recommend, hey, take a piece of each commission or something, put it aside. And when it's big enough, start investing in something.
Yep.
But,
absolutely.
Same with, I've talked to people like fix and flippers. Okay. When they quit, if they quit working, there's no money coming in. So take a little bit of each of your deals, a little bit of profit, put it aside, and start finding ways of passively investing. Just because you're an active investor doesn't mean you can't also be a passive investor.
Right. Exactly.
I mean, I've done that before as well.
Yep.
And I'm still doing that now, that I'm passively investing, while I'm still on the active side as well.
Yep. Same for me.
You just start putting some away and trusting somebody else with your money. And that way you don't have to put your time in. You continue to do what you're doing, make good money, and continue investing passively. I think that's the best way to go for someone that's, a high net worth, high income earner. That's a great way to go. Let somebody else grow your money for you.
Exactly. Okay. All right. So where can the listeners find you and get in contact with you?
Well, first of all, I have a little handout for everybody if they like. It's questions to ask deal sponsors if you want to come in as a passive investor. Okay. And for those active investors, it's questions that they may want to think about to make sure they have the answers to, when they're talking to passive investors. And they could get that at sigcre.com/sponsor. They can get a hold of me at jeff@synergetic.ig.com. Synergetic, you can see behind me, but also as SYNERGETICIG.com. And I'll be glad to talk to people.
Excellent. Well, thank you so much, Jeff, for coming on the show. It's been a pleasure getting to know you and your passion for protecting investors' money first, and then the IRR comes next. So appreciate your time, and let's stay in touch.
Thank you.